Right now, inside the cockpit of a private jet, Captain David is in a world of absolute, localized control. At 52 years old, he has spent decades mastering the variables and risks of flight, making split-second decisions that govern every movement of his aircraft. But as an independent 1099 contractor with no employees, that control vanishes the moment he looks at his finances. He is a high earner who is significantly behind on his retirement savings, operating without the safety net of a corporate pension or a matching plan. David has entered the fragile decade, that high-stakes window just before retirement where an investor's portfolio is at its largest and most vulnerable. There is no longer enough time to recover from a significant loss. This chart of the March 2020 crash illustrates the catastrophic threat of sequence of returns risk. For someone in the fragile decade, a plummet like this can wipe out trillions in value overnight, destroying a retirement timeline if forced to sell assets at the bottom. David faces a dual dilemma. He must find a way to legally shelter his current high income from the IRS, while guaranteeing those funds are never exposed to this kind of extreme market volatility. Without a structured system to dictate both how money enters his accounts and how it is shielded once it's there, a single unpredictable market event could end his career on the market's terms, not his own. To reclaim control, David uses the first structural lever of the tax code, the solo 401k. Because he has no employees, the IRS allows him to act as both the employee and the employer for contribution purposes. As the employee, he can defer $23,000 of his salary. Because he's over 50, he adds a $7,500 catch-up contribution, creating a total employee input of $30,500. Then, David pulls the second lever. Acting as his own employer, he can contribute up to an additional 25% of his eligible compensation into that same account, potentially pushing his annual pre-tax input above $69,000. Every dollar routed through these two levers reduces his current taxable income. He is redirecting capital that would have been lost to taxes and using it to hyperfund his future nest egg. This strategy creates a massive influx of pre-tax capital. Rather than sending that money here, to the IRS, he keeps it working for himself. By maximizing these solo 401k levers, David structurally solves his input problem, legally starving his current tax bill to maximize his compounding power. But simply generating that cash isn't enough. Dumping it into the standard stock market would violate his need for absolute control and leave his fragile decade vulnerable to another 2020-style crash. This is where David uses the second lever, the Qualified Fixed Indexed Annuity, or FIA. He uses his pre-tax solo 401k funds to purchase this contract from a highly rated insurance carrier. The FIA generates growth without direct market investment. Instead, its interest crediting is linked to the performance of an external index, like the S&P 500. This chart shows the upward mechanics. When the linked index goes up, David captures a defined portion of those gains, determined by a mathematical cap or participation rate. Once interest is credited at the end of the term, it is locked in. That growth becomes part of his permanent principal, creating a new, higher floor for the following year. The true control mechanism appears when the market experiences a negative return. During a market crash, the annuity simply credits 0% interest. David's account value flatlines, meaning he never loses a single penny of his premium or previously earned interest to market volatility. The FIA acts as a one-way financial valve. By accepting a cap on the unlimited upside, David successfully engineers a system that captures market-linked gains while mathematically eliminating the threat of market-driven losses. Back in the cockpit, David has fundamentally altered the physics of his financial environment. He has bridged the gap to his retirement by mirroring the precision of his flight deck in his portfolio. On the back end, any future distributions David takes from this qualified annuity will be taxed as ordinary income at his future tax rate. This trade-off is optimal for his situation. Delaying the tax hit maximized the volume of his compounding capital, while the annuity structure immunized his most vulnerable years from market shocks. Independent, high-earning professionals navigate the fragile decade by leveraging the tax code to supercharge their inputs and utilizing actuarial guarantees to structurally eliminate downside risk. They engineer a retirement that is predictable, guaranteed, and entirely under their control.